Today, I'll be explaining what went down in Meta's Q3 earnings report, exposing the truth behind Mark Zuckerberg's strategy, and most importantly, stick with me till the end to find out exactly why I think the stock could surge by 30%. Is this dip the biggest buying opportunity of the year, or is Meta just too risky? The shock of that single $16 billion tax bomb sent the stock tumbling 7% immediately. And by the end of the first day, Meta's stock had dropped a full 11%. But we've uncovered a surprising pattern. This sharp drop isn't a risk at all, and it could very well be a huge golden pit for smart investors. Also, why does the market treat Meta like the poor relative in the AI race, giving it a valuation as low as 24 times earnings? Mark Zuckerberg is simultaneously paying massive fines and dropping a massive amount of cash on open source AI. What on earth is his ultimate AI gameplay? We've got a lot to cover, so let's get right to it. Let's start by looking at Meta's Q3 report card. Clearly, the shocker that's stealing headlines was that one-time tax expense of $15.93 billion, making a dramatic miss in the EPS. This expense completely destroyed the reported earnings per share, and its root cause can be traced back to the Trump administration's tax reform bill. Imagine working hard all year, looking forward to collecting your bonus, only to be told that the money has to be used to pay off a historical debt. Even though it was a non-cash charge in Meta's case, it was enough to send investor sentiment to an absolute low. But wait, let's be real here. If we calmly strip away that tax bomb, Meta's core business performance was actually excellent. First, revenue soared by 26% year over year. This growth rate is even stronger than the previous quarter. And what ultimately drove it was advertising optimization powered by AI. Ad impressions grew 14%, which led to the average price per ad to increase 10%. Next, let's look at user engagement. Daily active people, or DAP, hit a massive 3.54 billion users, a jump of 8% year over year. This proves that Meta's social media empire, despite the constant challenges from TikTok and YouTube Shorts, still has incredible user stickiness. As for the most capital-intensive division, which is essentially expensive experimenting, Reality Labs burned through $4.4 billion this quarter. The operating margin was also dragged down to 40.1% by increased spending on AI business expansion and the development of Ray-Ban AI glasses. The good news here is Meta's advertising cash cow can absolutely handle the expense. They have $44 billion in cash reserves, which is more than enough to support Mark Zuckerberg's aggressive AI play. Do you think Meta's ad business can maintain its high growth rate while facing competition from TikTok and YouTube? Let me know your thoughts in the comments below. If Mark Zuckerberg is spending this aggressively, what exactly is his long-term strategy in the AI space? Many people consider Meta to be the underdog in the AI race, but Zuckerberg clearly disagrees. He has been pouring money into open-source AI to challenge OpenAI's closed model approach. Meta projects its capital expenditure for this year will hit between $70 billion and $72 billion, a massive $30 billion increase year over year. What's more is that Zuckerberg has already openly stated that this spending will increase significantly again in 2026, aimed at aligning Meta with the scale of Google and Microsoft. So, where is all of this money going? The answer is open source Llama, their biggest ace. Meta makes the Llama model architecture and code completely public, where developers can download it for free, customize, and modify it infinitely. Here's an analogy to explain the difference. OpenAI is selling a customized set menu in a luxury restaurant, or rather, a closed API model for peak performance. On the other hand, Meta is offering a free-flow buffet with a vast spread of premium dishes, or rather tools with its open-source Llama. Meta's logic is simple. I don't want you to pay me for my API. Instead, I want to attract as many developers and businesses as possible to join my platform. Once the entire industry uses my Llama, they will no longer need to pay for OpenAI's black box system. This strategy would allow Meta to gradually improve Llama's quality through the data flywheel effect. Another strategic move is its subtle integration of the Meta AI chatbot into their three major platforms: Facebook, WhatsApp, and Messenger. This gives it a massive 600 million monthly active users, creating a super distribution channel. Though the question here is, do you believe Meta's open source model can ultimately win against OpenAI's closed model approach? Although the open source layout is promising, some analysts argue that Meta's position faces significant threats from user attrition and an overspending risk. First, let's address the user attrition issue. Even though Meta's user base is evidently huge, it still faces competition on multiple fronts. YouTube Shorts is rapidly rising, and TikTok remains a black hole for screen time. When users spend their attention watching short videos on those platforms, they naturally spend less time scrolling through Facebook. This decline in user engagement is the impending doom hanging over Meta's head. The second issue is that Meta's AI spending is like a bottomless pit. Although Google and Microsoft are also spending heavily, Meta has the smallest revenue and profit scale of the three major tech giants. This makes the company far more sensitive to overspending. If that $70 billion poured into Llama and the Ray-Ban glasses doesn't yield the expected results, the resulting hit to Meta's stock price will be absolutely devastating. This is a battle fought with their back against the wall. Despite the mentioned risks, we can also see Meta's strong defense. Its Advantage Plus advertising products are using AI to boost advertisers' return on investment. This is, in itself, the most powerful driver of its revenue growth. When advertisers make money, they naturally continue to spend heavily on Meta's platforms. Now, let's address the question you've been waiting for. What are the prospects for Meta stock and how much higher can the share price go? If Meta shows even minor positive progress in AI, we project its valuation could climb sharply from its current 24 times earnings to 30 times earnings. There are three main reasons for this. First, being an underdog might actually be a good thing. Meta's current 24 times PE is significantly lower than the other Magnificent Seven tech giants. The market is pricing it as the weakest player in the AI race. But hey, if Meta does something right, even just a little bit, the stock is highly likely to explode. This is the definition of lower risk, higher potential return. Second, the foundation for the AI gameplay is the ad cash cow. While Mark Zuckerberg is spending $70 billion on AI infrastructure, let's not forget he has an advertising machine generating tens of billions in cash every year backing him up. Third, the key to valuation growth is Llama's comeback. Once Meta's AI strategy begins to work, for instance, if the Llama model successfully captures a significant share of the enterprise AI market, the market's view of the company will shift drastically. Its valuation could jump from 24 times to a re-rated 30 times. When combined with our conservative 10% EPS growth projection, this could push the company's target price up by 30%. So, what do you think? Can Meta's massive ad cash flow and low valuation overcome its AI spending war, making this the best time to buy? If you found this breakdown of Meta's strategy and valuation helpful, please remember to hit that like button and share this with a friend who might appreciate this analysis. Subscribe to TradingKey and click the notification bell, cause you won't want to miss the next episode where we'll be covering the earnings from another tech titan. See ya in the next one.